It was a interesting thing that we've seen year to date with regard to the value of the dollar. So you may have noticed or may have not noticed, most of our clients are familiar with this because we've been talking about it quite a bit, but the value of the dollar over the past 3 years, going back to November of 2022 through the end of May, is down about 11%. So 11% is a pretty stunning figure. But cyclically, and I've written about this quite a bit, there's like 3 articles over the past few years I've written about currency devaluation in general. And usually it's when we're talking about the euro, or we're talking about the yen, or we're talking about the UK pound, sterling pound. And here now we're seeing it with the US dollar. And cyclically, we've seen the dollar move up and down in value over the past 30 years quite a bit. It's gone up a lot, it's gone down a lot, it's gone up a lot, now it's coming down again. And so these are broad secular trends with regard to currency exchange rates. And year to date, I mean, it's basically fallen about 8%. Year to date. So cyclically, we've had this big drawdown, recovery. Well, there's something very interesting, and that's what this chart is really showing over these past 3 years, is this broader trend of having a hard time maintaining its value at a certain level. And why is that important? Well, depending on where you're at or what you believe economically or philosophically with regard to a strong dollar versus a weak dollar. Some economists would really favor a strong dollar. And they want a strong dollar because it gives us greater purchasing power relative to the rest of the world. It makes the goods and services of other countries much more affordable, and that could be a good thing for U.S. consumers, U.S. businesses as we're importing. Well, the opposite is true if we're not importing as much, and now there's all these tariffs on everything, and so that makes it not such a great thing. So there's a very interesting relationship between the value of the dollar and also U.S. yields, specifically the 10-year U.S. Treasury yield. And so over the past couple of years, you can see this great chart from the Financial Times in a recent article that they published. And since Liberation Day, that infamous date when tariffs went into effect with our trading partners around the world, that the U.S. 10-year U.S. yield actually has gone up since that period of time, and at the same time, the dollar values decreased. Why does the currency weaken? Why does that happen? Well, keep in mind that currencies are just like any other marketplace, any other good in a marketplace, which is it is subject to supply and demand. And so if you are alienating your trading partners through tariffs, well, there's going to be less demand to trade with you. It's going to be very expensive for your product to make its way into the U.S. Therefore, there's less demand for that product. But from the producer's standpoint, from that company that's importing into exporting from their country, and the U.S. is importing that good, there is this there is less demand for U.S. dollars, because if someone from Europe is exporting into the U.S., they have to convert their euro good into dollars. And if they're not making that export, and that import isn't happening, meaning they're then making that currency exchange from euros into dollars, there's less transactions happening around dollars, which is less demand for dollars. And when you have less demand for anything, the price of it goes down. And so this is the impact from tariffs, is that generally, because we're importing less, there's just less demand for dollars in that currency exchange from all these other nations, whether it's pounds, euros, yen, renminbi, pesos. They're not converting those currencies into US dollars because of the import-export dynamic. So that's something really important to keep in mind, something extremely interesting, which is maybe not something a lot of people have been thinking about, that the impact of tariffs isn't just about collecting money at the borders when we're importing things. It's that it creates this general weakening of demand for dollars globally. And then the other thing is that, all these countries around the world, developed nations, have debt. Japan has a tremendous amount of debt. The US has a tremendous amount of debt, so much so that you probably heard Moody's downgraded it. So the US is no longer a AAA rated country. Other countries around the world are, but the US is not, because of this extraordinary debt burden that we're carrying, about $36 trillion of public debt. So, and of course we're spending huge amounts of money on interest payments because interest rates are still rather high. So that is that's a problem. But more importantly, countries around the world that have been buying US debt, now because of this trade dynamic and also because of their own problems at home, whether it's Japan or China, and they have their own issues back home in terms of their economies, they're buying less US Treasury debt. That's less demand for these new issues that the government's coming out with. When there's less demand, the price goes down. When prices go down in bonds, when the price of a bond goes down, the yields actually go up in value. And so that is very much, I think, part of this dynamic that we're looking at here, which is a confluence of not only a pulling back of demand from foreign buyers, but also a pulling back of engagement with our trading partners internationally. And that creates this very, I would say, extraordinary divergence that, by the way, does happen historically through time. It's not like there's this perfect correlation all the time between US yields and the value of the dollar. This great chart that was from Bank of America, the Global Research Department. And you see something here that I think is very important to keep in mind, which is that 30-year real rates. And a real rate takes into account the inflation rate, so that net of inflation, here's the yield on a 30-year Treasury bond. And you can see we're basically close to November 08 levels. Well, even before that, you can see it was even higher, close to 4.5% of a real yield. Inflation at the time was around 2 something, but the 30-year US Treasury was around 6.5%. 6.5%. Right now it's around 5 and change. So there is actually a history that shows us that we could very easily find ourselves in higher interest rates on the long end of the yield curve. 10-year could be closer to 5.5%, 6%. 30 years could be 6%, 6.5%. And that would not be unusual from a historical perspective. And really, when you look at 10-year US Treasuries, 5% is kind of a normal-ish rate that an investor would get. And that is your basis. Your Treasury yields in the US are your risk-free rates. And so that's your reference rate. So corporate bonds reference that, mortgages reference that. Everything's really referenced around risk-free rates. So I think it's also very important on a forward-looking basis to understand that interest rates, or I should say specifically yields on fixed income instruments like treasuries, like corporate bonds, they actually could, in fact, go higher. And that is simply a function of supply and demand for those particular securities.